In the industrial haze of Yantai, a coastal city in China's Shandong province, the smokestacks hum quietly as the world barely notices a company standing at the intersection of ambition and uncertainty, Chijet Motor Company. On paper, Chijet describes itself as a new energy vehicle manufacturer, a hybrid maker of both electric and internal combustion vehicles. Its registered headquarters sit at 8 Beijing South Road within the Yantai Economic and Technological Development Zone, one of China's hubs for automotive innovation. At first glance, it seems like another player in China's electric vehicle revolution. But when investors began peeling back the layers, balance sheets, filings, and market actions, the story became far more puzzling. Founded in 2009, Chijet remained obscure for years, operating mainly in regional manufacturing circles. That changed in June 2023 when it merged with Jupiter Wellness Acquisition Corp., a US-based SPAC, Special Purpose Acquisition Company, and gained a NASDAQ listing under ticker CJET. The merger was marketed as the company's grand entry into the global EV arena, with promises of international expansion, proprietary technology, and modern manufacturing infrastructure. Investors saw echoes of other Chinese EV success stories, but unlike them, Chijet's fundamentals were never clearly defined. Then came July 2024. The company announced a 1-for-30 reverse stock split disclosed in a pre-market filing. A reverse split in corporate finance is typically a move of last resort, an attempt to inflate the per-share price when it falls below the NASDAQ minimum bid requirement of $1. It's a cosmetic maneuver, not a sign of recovery. Normally, financially stable firms focus on improving revenue, reducing costs, or unveiling tangible innovation to support their valuation. Chijet instead chose the numerical shortcut. The outcome was swift. By August 2024, barely a month after the reverse split, NASDAQ issued a deficiency notice citing noncompliance with minimum market value requirements. Such a rapid relapse is highly unusual. A reverse split usually buys a company months of breathing room. For Chijet to fall out of compliance so quickly suggests something more systemic. Either the stock collapsed immediately after the split, or investors had already lost faith in the company's entire story. Then, in September 2025, Chijet resurfaced with a new announcement, an $8 million public offering priced at 59 cents per share. Again, the filing came before the market opened. Seasoned investors recognized what this meant: liquidity stress. Companies frequently tapping the market for small, repetitive fundraisers are often struggling to maintain operations. Only days later, on September 26, 2025, Chijet issued another press release. It had entered into a private placement agreement worth up to $20 million. Private placements differ from public offerings. They involve raising funds directly from select investors rather than the broader market. Healthy companies prefer public offerings because they're transparent and demonstrate confidence. Private placements, on the other hand, are often used by firms under financial strain seeking immediate cash. What came next deepened the mystery. The closing of this private placement was announced just 10 days later. In standard capital markets practice, a transaction of that scale involves weeks, sometimes months, of due diligence, fund transfers, legal clearances, and escrow procedures. To execute and close it in 10 days defies normal financial timelines. It raises the possibility that the deal may not have been a straightforward infusion of external funds, but rather a structured internal transaction, a bridge arrangement, or even a form of accounting, window dressing, to project liquidity. Then came the October 2025 shock. Chijet announced a Memorandum of Understanding, MOU, expanding that very same private placement from $20 million to as much as $1 billion, a 50-fold leap. Yet the focus of this new arrangement was not automotive manufacturing at all. Instead, the company declared plans to enter the digital asset custody business, the field of securing and managing blockchain-based assets for institutional clients. That single announcement changed everything. Why would an automotive manufacturer pivot into cryptocurrency custody, where one of the most regulation-heavy, technologically demanding sectors in fintech? Under ordinary circumstances, a car company expanding into new lines of business would stay within adjacent industries, battery systems, autonomous driving, or vehicle electronics, areas that align with their existing capabilities. Chijet's pivot, however, veered sharply off course. Digital asset custody requires infrastructure more akin to banking or cybersecurity than to automotive assembly lines. It's a business that depends on regulatory licensing, encryption technologies, and financial trust, none of which align with Chijet's declared expertise. The market took notice. Some analysts speculated that this was an attempt to reposition the company toward the buzzword-heavy world of Web3 and blockchain, where investor enthusiasm often substitutes for real revenue. Others suspected that Chijet was trying to buy time, leveraging attention from bold, futuristic headlines to offset growing concerns about its weak fundamentals. Still, the company continued touting its Yantai EV plant, its Jilin manufacturing base, and even claimed to be exporting vehicles to Algeria and South America. Yet none of this was visible in its financial disclosures. Losses persisted, and cash flow remained negative. Under normal industrial logic, active production and international exports would reflect in increased sales and improving margins. But Chijet's statements showed no such results. By late October 2025, NASDAQ issued another minimum bid price deficiency notice. The filing came after market close. Despite its earlier reverse split, Chijet had once again fallen below the $1 threshold, only 4 months later. In most cases, companies respond to such repeated warnings by launching restructuring efforts, cost-cutting programs, or forming strategic partnerships. Chijet, however, responded the same way it always had, with new fundraising announcements and vague promises of transformation. At this point, the central question emerges: is Chijet truly an automaker, or merely a narrative machine, surviving on press releases rather than production? This story matters far beyond one company's peculiar trajectory. It exposes the fragile architecture of market trust, how easily it can be built through compelling language, and how quickly it can disintegrate when numbers don't align. It highlights the fine line between ambition and illusion in the speculative edge of the stock market. For investors, the lesson is stark. Press releases are not profits. Real companies are measured by delivery, by production, by earnings, not by their ability to tell a good story. Whether Chijet's next disclosure will reveal genuine growth or another elaborate distraction remains to be seen. The ValueStir channel invites you to share your discoveries, suspicions, and insights about listed, unlisted, or soon-to-be listed stocks and coins that deserve deeper investigation. Drop your thoughts in the comments. Your lead could become our next featured investigation. And to all of you who watch, subscribe, like, comment, and share our videos, thank you. Your engagement fuels our work, and we promise to bring you even sharper, more revealing stories ahead. This was ValueStir.